Hi, and welcome to the latest October update, the market outlook. There's a few things I wanted to talk about today, and look, we'll kick off, as we often do, talking about the US Central Bank, the Federal Reserve. They cut rates last month, around the middle of September. They cut rates by, probably a little bit more than people had expected, 0.5%. And that was interesting because in making that cut, in the accompanying statement, they spoke about the fact that really the economy is still quite resilient, and inflation pressures, while they're easing, there's still plenty of life left in inflation. So interesting that they were somewhat preemptive in cutting rates in September. Now, of course, markets being markets, they then extrapolate all of these rate cuts forward. And in the immediate aftermath anyway of the Fed's cut, expectations moved to another 0.5 percentage point cut being expected in November, and then just 0.25 percentage point cut come December. So they've got 2 more meetings this year. In the days and weeks that have followed that, we've seen that those expectations have been wound back a little bit, and that's been particularly the case following some more robust than expected employment numbers very early in October. And employment numbers, they are about the most important number at the moment. The Fed's focus has moved on a little bit from inflation, although of course if inflation were to roll back, their focus would go back to inflation. But for the moment, the Fed is assuming that inflation pressures will continue to ease, and that seems fair. So their focus is now on employment. So any and every number that relates to employment in the United States will get an outsized market focus and potentially outsized market reaction should the numbers be significantly away from expectations. So anyway, the Fed has started their rate cut cycle, kicked off 50 basis points, a little bit more than people had expected, and that they are very likely, on the basis of what we know today, to continue to cut rates through the rest of the year. So this really turns our minds, all investors' minds really, to how do markets tend to perform during rate cut cycles. Well, that depends very, very much on the speed at which the economy slows, whether it slows rapidly, whether it falls away quite sharply. That kind of scenario, if you like, a negative growth surprise, that's often quite negative for equities. But what works really, really well for equities is a rate cut cycle, which we seem to have started, easing inflation, which seems to be occurring, and only a modest pace of slowdown, a soft landing, in other words. And that seems at the moment to be panning out as well. So that's, broadly speaking, historically been a reasonably positive background or environment for equity markets. And in fact, whilst we are a little bit cautious, I guess markets are at record highs, equity markets are at record highs, but all of these underlying dynamics still seem to be suggestive of a reasonably positive outcome as the rate cuts continue. We don't have a number of the precursors that can lead to sharp market sell-offs and sharp economic contractions, things like overinvestment, over leverage, wage growth that's still accelerating, overinvestment. Those are the types of factors that tend to lead or are precursors to a nasty slowdown. We don't really have those at this point in time. A couple of other things I wanted to focus on. One is China. So in the last several weeks, the Chinese authorities have announced a number of measures, mainly related to cutting interest rates, mainly related to increasing market liquidity, particularly in the equity market. And we've seen a very, very significant market reaction to those policy changes. Now, we think that part of that is because market positioning was very, very extreme. And by that I mean, we've been having investors, many investors, talking about the fact that, in their view, the Chinese market was uninvestable. They've been saying that for 18 months, 2 years, possibly longer. So many investors have left the Chinese market. So you only need very small moves for market reactions to be quite significant. And we think that in part, possibly in large part, has really been the key driver of very, very significant moves in the mainland Chinese market and the Hong Kong market as well. Where we go from here will really depend upon whether or not the Chinese authorities move more so into fiscal, big investment, spending type measures, because we think that that's probably what they need to do to have a more definitive and powerful effect on the Chinese economy and then on Chinese markets. So for now, it seems to us more a story of market positioning and the correcting of very, very extreme negative views, more so than the beginning of a strong and solidly underpinned recovery in the Chinese economy. Now, turning just quickly then to Australia, we here have one of the very few reserve banks, central banks in the world that hasn't cut rates, and our central bank is continuing to push back against expectations of rate cuts, and there are a couple of reasons for this. One relates to the nature of the economy itself, where employment in particular is still doing really quite solidly. The unemployment rate has risen, but only very, very slightly. But the other, probably more important factor for the Reserve Bank is the inflation story. And whilst inflation is easing, both on a monthly rate of change and a quarterly rate of change, it's also coming down, if you like, on an annual rate of change. And in fact, the most recent monthly numbers, and probably the next few monthly numbers, will show that the annual rate of growth in the Australian inflation rate is back within the Reserve Bank's 2 to 3% band. However, just getting into the band is not enough for the RBA, understandably. They want to be very, very confident that after getting into the band, inflation will stay within that 2 to 3% band. So they've been very, very reluctant and continue to push back on market expectations about rate cuts. But it does seem very likely that we'll be getting rate cuts here in Australia, certainly by February, and there is an outside chance, if the economy were to weaken quite significantly from today through the rest of the year, in tandem with lower and lower inflation outcomes, that the RBA could potentially move and cut rates before the end of the year. So drawing all that together, looking around the globe, but mainly focused on the US, we see that the underlying ingredients for a soft landing still, on balance, seem more likely than not. That being the case, whilst we're cautious, we are relatively optimistic about the outlooks for markets. Thank you.